What an absolute mess. Today's market price action is the official definition of dumpster fire in Harvard's dictionary. Today was as messy as your 3-year-old discovering crayons or your first divorce. So to bring you up to speed, here's a quick recap. SMCI is in shambles. They use their own revenue to buy their own fake products and then recycle those fake products back onto their balance sheet because fraud and growth. This entire saga was unraveled by a 15-year-old on Reddit and Google Maps. Big tech earnings is looking like sour milk, and if you actually exclude the big names, the broader market is actually still reporting negative growth. The bond market continues to point the middle finger at the Fed, and apparently everybody has jobs. So become a channel member and let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map for the S&P 500 and a very ugly day. US stocks tumbled on the back of technology stocks, especially after Meta's earnings and Microsoft earnings, because Wall Street is starting to ask the questions, where is the return on investment after all this AI spending? The market not seeing it, Wall Street not seeing it, and now they're starting to punish investment teams. And this meant selling in Meta, selling in Microsoft, which led selling in Apple, Google, Amazon, Tesla, Nvidia, semiconductors, and momentum brings momentum. When the big guys sell, the whole market sells. And as a result, we saw selling in financials, real estate, industrials was very ugly. And where did we see buying today? Defensive sectors, telecom services, utilities, energy, as well as consumer defensive. So concerns about profitability putting pressure on the overall market today. And this is not the type of stuff you want to see heading into the fourth quarter. However, that did not unsettle the mood in Amazon. Now, Amazon was down 3% into the close, but it reported earnings. It jumped nearly 4%, actually positive for the day, nearly 1% up for the day. And they reported stronger than expected earnings, stronger than expected revenue, and guidance was very upbeat. Stuff like revenue, they guided $5 billion above Wall Street's expectations. Operating income, the street was expecting $17 billion in guidance. Amazon guided for $20 billion in the fourth quarter. Very upbeat stuff. Guys, Apple, very mixed earnings as well. They reported after the bell. And I don't know how I feel about this, right? They actually beat on revenue, missed on EPS. Now, they reported EPS of 97 cents. The street was expecting $1.57. Here's the caveat though. They incurred a one-time $13 billion charge for back taxes in Ireland, which is criminal if you ask me. And that meant earnings actually missed by a wide margin. If you actually include the one-time charge, EPS would have come in at $1.64, smashing EPS expectation. That actually saw revenue grow in the high single digits year over year. I think this was a very strong quarter for Apple. It's just that the regulatory environment we're in right now is just not that great. It's not supportive for these big tech companies. And that's why Apple is actually down here in the after hours. Nonetheless, I thought there was very positive action on Apple AI, among other stuff, and their guidance was actually largely intact. Looking past the volatility we're seeing right now, these earnings should be a tailwind for Apple. The problem is just valuation concerns with that miss on EPS. Uber also reported earnings, guys. This was the story of earnings season so far. These companies are beating on revenue, beating on earnings. Guidance is just missing Wall Street's expectations and they're getting punished. Uber's gross bookings missed Wall Street's expectations. They were expecting like 19% growth. Uber guided for like 17% in gross bookings for the quarter, for next quarter, and down 8%, getting absolutely smashed. However, if you were a shareholder like me of Paycom, they were up 21% after yesterday's earnings, guys. Very strong reaction. I think most of the gains have been pulled forward for the quarter. My fair value is about 211 nonetheless, and we're going to see margin improvement across the board over the next 12 to 24 months. This management team doing the right things, and it's just business as usual with more profitability for shareholders. Looking at other companies that reported earnings today, we had stuff like MasterCard. They beat on earnings, beat on revenue, business as usual. Merck, very much the same thing. Comcast beat on earnings, beat on revenue, and they did come out and mention they were going to sell some of their cable divisions, so that is affecting overall sentiment right now. We also had ConocoPhillips. They reported great earnings, beat EPS, but missed on revenue. BMY, a huge earnings beat, and then Intel right here missed earnings by a wide margin. expectation. The expectation was for a 2 cents decline. It saw a decline of 46 cents. However, Intel was up as much as 12% in the after hours after some very solid Q4 guidance. And that just goes to show you can have terrible earnings, but if your guidance is good, your stock should be fine. But what we're seeing right now in the market is that earnings for these companies is actually good. Guidance is coming in line. It's just that the street doesn't like what's happening with all this artificial intelligence spending. They want to see an ROI now, and they're just not seeing that return. And that's why we're getting a lot of trepidation and volatility in the market. And that is why tech stocks, the XLK down 3% today. The SPY fell 2%. Very, very ugly day. And we saw real estate, discretionary, financials, materials, industrials. They were all down in excess of 1%. The best performing sectors, XLU, XLE, defensive sectors, and even look at the third and fourth best sectors, XLP, staples, and healthcare, right? And staples was positive for most of the day. So we really saw a rotation out of technology mostly into just defensive sectors. And maybe that has to do with some of the market dynamics we're seeing. Maybe that has to do with election volatility, but there's very clear defensive plays going on in the market right now. And it wasn't just large caps, small caps too, mid caps too. Really, the only place that was kind of a safe bet was large cap and mid cap value, which is just like defensive sectors pretty much. And then small cap value, small cap core, small cap growth got absolutely smashed. But the worst performing factor segment was large growth, down 2.6%. Very, very ugly day in the markets here today, guys, despite very positive economic data. If you look at the core PCE price index month over month, year over year, came in at 0.3 versus the consensus 0.3. The PCE data came in line. Chicago PMIs missed. However, initial jobless claims beat expectations. Personal spending beat expectations. Personal income came in line. And this right here pretty much goes to show the consumer is still hanging in there, still spending more month over month. You like to see that. And tomorrow is the NFP print as well as some manufacturing data, guys. So we got very strong economic data today, but the technical drivers and fundamental drivers really hindering stocks today. And it was an ugly day. There's no two ways to go about it. 71% of stocks and 73% of stocks declined on the NYSE and the Nasdaq. And we actually saw shorter term weakness lead into medium term weakness. The 50-day moving average losing its 50% level. You don't want to see that. The 100-day to 200-day looking very, very solid, still looking robust. However, it moves from one to the other. If we have another couple of days of terrible price action, we could really see the 100-day moving average fall, and then things get really, really ugly. So guys, the Q4 rally is officially on hold. It's on pause. Let's get through the election volatility. Let's get through the selling. I think we're going to see a garden variety 5 to 10% pullback over the next couple of weeks leading up into this election, and then the Q4 rally can resume from a lower base. But expect volatility between now and the election, maybe even into mid-November. And let's hop on the charts. Now guys, the monthly candles officially closed out. The month of October is officially done. We're in November, and this was a negative month for the S&P 500. And this is the sector analysis chart looking at the monthly returns for all of the sectors, and you can see the S&P 500 down 0.5% for the month of October, the RTY down 1.26% for the month of October, and the only gainers was the XLF, XLC, XLE. They had very robust returns. This was weighed by stuff like XLU, XLY, XLK, which was down big. The XLK was positive for most of the month. It's just in the last couple of days after the earnings season, we saw a massive pullback, meaning that the overall S&P 500 was actually down for the month of October. The discretionary space was down 2% as well. And we just saw selling across the board. But guys, this is still technically seasonal weakness. I think we're going to see a little bit of volatility into the election, maybe into the middle part of November as much as there. And then the Q4 rally will continue. I'm still bullish on an end of year run. I'm still bullish on stocks. I think we're just going to see a garden variety pullback. But despite the month we had, a red month right here, things look very, very good on a monthly chart. You know, higher highs, higher lows, and while not a new all-time high close, we did get new all-time high wicks on the monthly chart. Everything looks really, really robust until we actually go ahead and break the 43.83 level. This was the all-time highs we made here in 2021. So we can pull back as far as this level right here and still be in a technical uptrend as long as we find support and go from there. I mean, in perfect world, the these are the real lows where we actually make lower lows, but some people would say these wicks. Personally, on a monthly chart, you really have to look at these big swings, right? This was just a red month that happened in the last couple of days, led by tech stocks. All in all, markets look robust and they look poised to go higher. We're just seeing a little bit of volatility, and if we do get a pullback, you want to be buying those dips because things look very good for earnings from the fundamental picture, the macro side, and even technically it's going to take a lot to break this market, and you do want to stay invested in equities. Looking at the weekly chart, things do look a little bit different. Now, still clearly in an uptrend, higher highs, higher lows. We did make a new all-time high in the last couple of weeks, but we have seen a pullback, and we're actually in negative gamma, guys. Now, these are the daily levels, I understand, and we actually ended the day at the put support. So these are going to move down tomorrow, obviously, but where they move down is going to determine what happens next. Now, we are seeing a little bit of positive momentum here in the after hours after those earnings from Amazon and Apple, as well as a couple of other names like MasterCard, and the SPY is up 0.12%, but the RSP is still down, the IWM is still down, and we are seeing a little bit of respite here in yields. Now, these are the after hours price action, and we actually saw declines in yields today. This is the after hours momentum. This is what actually happened today, and yields were down 0.09% in the 10-year yield, but we actually saw more of a move down in the 30-year yield, down 0.62%, as well as the 2-year yield, I believe, down 0.31%. So yields did move lower today. The dollar also moved lower today, and that's the positive correlation we'd be talking about. If yields go up, the dollar's going to go up. If yields go down, the dollar's going to go down. And in a perfect world where we got perfect earnings, this market action right here would actually be a tailwind for the stock market right now. However, earnings and the fundamental picture is driving market momentum despite the technical drivers doing what they did. Once we get past all of this earnings volatility, and if yields continue to move down like I expect they should, the dollar continues to move down, that should actually be a tailwind for equities into the end of the year. Guys, commodities were kind of flat today, still positive. Gold is up 0.12%, silver pretty much flat, crude up 1.82%, and going back to the S&P 500 and the daily chart, guys, you can see we had a huge gap down into negative gamma, and then it was just selling all the way to the put support. We actually go on the 1-day chart. You can see a gap down, right? And then it was just lower lows, lower highs. And we did see some sideways momentum here and then into the close. We close out the day at the 57.05 level. So we closed at the 5700, officially in negative gamma. I think the put support is probably going to move closer to like the 56.25 level right there. We'll see what happens, but we are in negative gamma right now, and that means you want to buy or sell with the trend, sell into weakness, buy into strength. But we'll see what happens in the after hours. There's just a lot of dynamics at play here with earnings, and the big names are really driving the market right now. Looking at the gamma levels for the Nasdaq 100, very much the same thing. Officially in negative gamma, guys. That means you sell into weakness and you buy into strength. Causes a lot of volatility, and we're not quite at the put support. So the market could actually find a little bit of support here, especially with what's happening in the after hours. We'll see. And then the RTY, like the S&P 500 at the put support, these levels are going to move lower tomorrow. However, the RTY needs to hold this low right here. If it can do that, that's positive. If it breaks like this level, I would say closer to the 2180 level, this is probably our next target zone, closer to the 2100 level. If you're going to sell equities, the very first thing people sell is the IWM, is small caps in their portfolio, just because these companies are of less quality compared to the mega caps. All in all, guys, volatility, we're seeing it. This could be election volatility, seasonal volatility, earnings volatility. It's everything in between. But do expect this volatility to continue and churn until after the election, and maybe into as far as the middle of November, and then should continue the Q4 rally. I remain bullish, and I am a buyer of dips the lower we go in the S&P 500. Volatility is the price we pay for outsized market returns in stocks, and when you do look at it, if we go on a percentage return basis, year to date, we're still up 20% for the year in the S&P 500. Very solid stuff. And guys, let's talk about sentiment. This is the AAI sentiment survey. What direction direction do these members feel the stock market will be in the next 6 months? And we saw 39.5% of sentiment votes in the bullish camp, 30.9% in the bearish camp, 29.6% here in the neutral camp, and we pretty much saw a slight uptick in bullish sentiment, a slight uptick in bearish sentiment, and those that were neutral essentially just picked sides, said, hey, I want to get bearish, I want to get bullish, and that's why we're really seeing market trading at all-time highs, but we're also seeing quite a bit of trepidation in the market. We've had a huge run-up in the last 6 weeks. The S&P 500, excluding this week, has seen 6 weeks worth of gains. Same too with the Nasdaq 100. And when you've had such a big run-up, you're going to see sentiment on both sides of the aisle. Nonetheless, we are still seeing elevated bullish sentiment relative to historical averages. The historical average is about 33%, so this is still an elevated figure. And bearish sentiment, while not elevated relative to history, it's elevated relative to the last 4 weeks, as you can see based on these figures right here. And generally speaking, guys, when we've had 6 weeks of returns of consecutive up weeks like we have had in the S&P 500, things can get shaky, especially in the following week and 4 weeks thereafter. S&P 500 returns at the end of 6 consecutive up weeks tend to be negative 0.3% 1 week later, negative 1.2% 4 weeks later, and very poor hit rates, 36 and 31% respectively. So the trepidation we are seeing in the market, this largely has to do with historical seasonality that happens after 6 consecutive up weeks, along with some of the other dynamics we're seeing in the market, elevated valuations, yields, the dollar, geopolitical concerns, the election, as well as earnings. If we actually look at EPS estimates excluding tech and communication services from the 16th of August to where we are right now, we actually saw massive downward revisions from about 2% all the way to negative 1% on October 15th. And since then, we have seen a mild uptick, although still sitting slightly in negative territory. This is excluding the big tech and communication earners, so Nvidia, Apple, Microsoft, Google. If you exclude these guys, the overall broad market this quarter is actually not growing earnings, slightly flat, slightly negative this quarter. And so with tech making up the majority of earnings, if their earnings figures and guidance figures do miss, particularly their guidance figures, that can cause trepidation in the market. Look at Meta, great earnings, solid guidance, capex figures, the market didn't like that, and we did see a bit of a pullback after its earnings release. Same thing with Microsoft, and that is part of the reason why we're seeing trepidation in the market, followed with everything I just mentioned earlier, and the fact we've had 6 consecutive up weeks, excluding this week. But guys, when you actually look at the third quarter and then zoom out, things look much different. This is the latest S&P 500 earnings figures, guys, and you can see comm services and tech are making up the majority of earnings, but that's not to say that other sectors aren't gaining. We are seeing very robust earnings in healthcare, financials, as well as consumer discretionary, and we're also seeing margin profiles stay very solid across the board. What's really hurting earnings right now is energy, industrials, and materials, particularly industrials and energy here on the revenue side. That is really painful for investors. Nonetheless, all things considered, the S&P 500 in total, because if you are buying the index, you are getting the tech names, you are getting the energy names, and everything in between. Earnings growth is sitting at 6% for the quarter, 5.5% if you exclude energy, and revenue sitting at 4.5%. The same is true removing energy as well. And we are beating analyst estimates ever so slightly. So despite what we're seeing at the index level, fundamental picture is sound, and that's earnings are growing, revenue is growing, margins very solid, and 77.4% of companies are reporting above analyst expectations. 257 companies have reported, so about half, and that's exactly what you want to see if you are holding stocks. You want to see earnings growth. And with the fundamental picture intact and the macro picture intact, the S&P 500 has gone 29 days in a row without a 1% swing in the S&P 500. This doesn't include today's price action. It includes everything before today, and you need to go back prior to COVID to find a longer stretch where we haven't had such volatility. 29 days in a row, and in 2021 we had 22 days in a row. So this is so we are seeing very, very linear returns in the market, and that's why when we get volatility like this, and like this, it almost feels as if the market is falling apart. But that all has to do with perspective and what we've experienced in the last 12 to 18 months. Looking at the macro now, guys, looking at the economy. Yesterday, we got GDP data. Now, it missed analysts' expectations. The market was expecting 3%. We reported 2.8%, but this was still a solid GDP print for the third quarter. We saw strong consumption, especially in goods. Equipment spending jumped, offsetting the drag from structures and residential. And we also got a very strong boost from defense, the strongest since the second quarter 2023. If we actually look at final demand, it was at 3.5%, and final sales to private domestic purchases at 3.2%. This was very, very strong data across the board. We saw real personal consumption expenditures, PCE, coming at 3.7%, and there's the final sales to domestic purchases. What was especially notable was services spending was still solid, guys, running ahead of the pre-pandemic trend for 5 quarters in a row, and we also had strong government spending, particularly at the state and local level. This is in sharp contrast to 2010 to 2013, coming out of the GFC and the recovery we saw thereafter. And now services and government make up 64% of GDP. I don't know how I feel about that, but it is what it is. And these are the figures we have to contend with. But let's switch gears, guys, and actually talk about the election and what's to come if we get a Kamala win or a Trump win. What are their plans? And both candidates are proposing deficit widening policies. This is an article from UBS. They say business owners can cheer on various parts of each candidate's plan, but also keep in mind the high degree of uncertainty when it comes to passing legislation, especially with a divided government. Now, let's look at Harris's plan. Now, guys, up is deficit widening, below is narrowing the deficit. Harris plans a $50K startup credit, $8,000 first-time homebuyer credit. She plans to extend the child tax credit and expand ACA premiums. She expects to raise the corporate tax from 21% to 28%. She also expects a higher capital gains tax, not good, and then NIIT Medicare tax as well. So this should bring in funds. This should let it go. We still have about a $3 trillion deficit right there. Trump's plan, he has less regulatory scrutiny, especially for financials, industrials, fossil fuels, no income tax on overtime, and social security, huge. Lower corporate tax rate to 15% for domestic manufacturers. I do like that. Global 10% tariff, wow. And to reverse current energy policies and expand production. We should see Trump's plan cost him $10 trillion in his 4 years and to bring in $3.7 trillion. We should see a deficit there of 6 to 7 trillion. I don't know how I feel about that. Nonetheless, where they both come into the middle is no taxes on tips, and they're going to extend the TCJA tax cuts, which means that if we do get a divided government, based on this right here, we probably should see Trump's tax cuts that he gave us in 2016 to continue probably to 2030. And then no taxes on tips. I mean, we'll see what that does for tipping culture, but those are the plans for both Harris and Trump. And where are the polls right now? Well, this isn't exactly the polls. This is the betting markets. And right now, Donald Trump has a 60% chance of winning. Kamala Harris only 40%. We have seen a slight uptick here in the Harris campaign. Nonetheless, a huge move to the upside for the Trump campaign since early October. We'll see what it's like on election day, but with just 5 days until the election, it does look like a Trump victory is going to come to par. And that's why we have seen Trump stocks rallying. But I think based on this right here, you are definitely going to see a huge reflation trade. That is part of the reason why I actually hold gold and have a small allocation to gold. But it should be overall good for equities, especially if we get those tax cuts that he's talking about. And if we do get Republicans in Congress. Looking at earnings for the rest of the week, guys, it sort of slows down tomorrow. We have Fubo, Chevron, Exxon, big names nonetheless, not as big as we saw in this past last week. Huge week of earnings. We had winners this week, guys. We also had losers. That's what earnings season is all about. And we also have a pretty huge week next week. But this was the big one. This was the big week this earnings season. Looking at data for the rest of the week, guys, the big thing is tomorrow non-farm payrolls and the unemployment rate. We also get the ISM manufacturing numbers. Now, consensus estimates right there for non-farms is to come in at 115K. The forecast is 180K. Now, ADP actually beat expectations by 100%. The market was expecting 115K for ADP payrolls, private payrolls. It came in at 255. So I do expect a huge beat on the consensus estimates. The market also expects the unemployment rate to come in at 4.1 or maybe 4.2%. But if we get a huge beat, we could actually see 4%. And then the ISM manufacturing PMIs to come in at 47.6. Forecast is 47.5. So around the 47.5, 47.6 mark. Anything higher than this, that'll be a real positive, especially for manufacturing and overall industrials. And the manufacturing component of the PMIs continue to be in a recession. Manufacturing and durables still not out of that recession that most of the market exited at the end of last year, at the start of this year. But guys, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.